If you look at the S&P 500 right now, you would think the American economy is invincible. We see all-time highs, AI booming, and consumer spending holding up. But if you stop looking at the stock ticker and start looking at the government's checkbook, a completely different and terrifying reality begins to emerge. We are walking into a mathematical trap. It's not a theory. It is written in black and white in the Congressional Budget Office's projections for fiscal year 2026. As we approach 2026, the United States is facing a triple threat that we haven't seen in generations: the expiration of major tax cuts, interest payments on our debt exceeding our defense budget, and a stubborn floor on inflation that is eroding the middle class faster than wages can grow. The government has a plan to deal with this mountain of debt, but I promise you, you aren't going to like it. Their plan involves two levers: higher taxes on your income and the devaluation of the dollars in your savings account. In the next 10 minutes, I am going to show you the 2026 budget trap. We will break down exactly which taxes are set to skyrocket on January the 1st, why your cash is becoming a liability, and most importantly, I'm going to share the specific asset classes that smart money is moving into right now to survive the shift. Welcome to the Capital Sense. Let's follow the money. To understand why 2026 is such a critical year, we have to look at the debt spiral. For decades, politicians told us that deficits don't matter. They said we could borrow forever because interest rates would stay low forever. Well, the bill has finally come due. As of the fiscal outlook for 2026, the United States government is now spending more money on net interest, that is, just paying the yield to bondholders, than it spends on the entire United States military. Think about that. We are spending more to service our past mistakes than we are on our current national security. According to the Committee for a Responsible Federal Budget, interest payments are on track to hit $1.6 to $1.7 trillion annually. This creates a vicious cycle. The government has to borrow more money just to pay the interest on the old money. This is what economists call a debt trap. When a developing nation hits this point, they usually default. But the US is the world reserve currency. We can't default, at least not explicitly. So, what is the alternative? It's a phenomenon called financial repression. This is a strategy used by governments to liquidate debt by keeping interest rates below the rate of inflation. Essentially, they pay bondholders back with dollars that are worth less than when they were borrowed. For you, the viewer, this means one thing: the government needs inflation. They might publicly say they are fighting it, but mathematically, they need inflation to stay higher than the interest rate on the debt to burn away the real value of what they owe. If you are holding large amounts of cash in a standard checking account, you are effectively donating your wealth to the US Treasury. You are the victim of this financial repression. In 2026, cash isn't safe. Cash is a guaranteed loss of purchasing power. But the government can't just inflate the debt away. They also need more revenue. And this brings us to the most urgent part of this video: the expiration of the Tax Cuts and Jobs Act. Back in 2017, the tax code was overhauled. Income tax rates were lowered and the standard deduction was nearly doubled. But there was a catch. To make the math work in the Senate, these tax cuts for individuals were written with an expiration date, December the 31st, 2025. Unless Congress passes a new law, which, given the current gridlock, is far from guaranteed, we are staring at the single largest automatic tax increase in American history. Let's look at the damage. First, marginal tax rates. Right now, if you're in the 12% bracket, that jumps back to 15%. The 22% bracket, that climbs to 25%. The 24% bracket jumps to 28%. You might think, oh, that's just 3%. No, a jump from 22 to 25% is a roughly 13% increase in the tax you owe on that income. That is a direct pay cut. Second, the standard deduction. This is the silent killer for the middle class. Currently, A married couple filing jointly enjoys a standard deduction of over $29,000. In 2026, that gets cut roughly in half. This means an additional $14,000 to $15,000 of your income suddenly becomes taxable. If you are a freelancer or a small business owner, the Section 99A deduction, which allows you to deduct 20% of your qualified business income, also disappears. That is a massive blow to the side hustle economy. I want you to really internalize this. At the exact moment when inflation is making groceries and housing more expensive, the government is scheduled to take a larger slice of your paycheck. This is the budget trap. They are squeezing you from both ends. Higher prices at the store and higher taxes on your pay stub. Now, I see a lot of comments asking, won't the economy just crash? Won't prices come down? This is where we need to talk about the difference between disinflation and deflation. Disinflation means prices rise slower, while deflation means prices actually drop. The government cannot afford deflation. Remember the debt spiral. If prices drop, GDP drops and tax revenue drops, but the debt stays the same. That would bankrupt the system immediately. The 2026 budget structure ensures a floor on inflation. We are seeing massive government spending programs, from the Infrastructure Bill to the CHIPS Act, pumping billions into the economy. When the government spends money it doesn't have, it increases the money supply. We also have structural inflation. De-globalization is happening. We are bringing manufacturing back to the US. That's good for jobs, but it's bad for prices. American labor is expensive. So, while the Fed might get inflation down to 2.5 or 3%, the days of 0% inflation are likely over. We are entering a period of sticky inflation. If your boss gives you a 3% raise and inflation is 3.5%, and your taxes go up by 3% because of the tax cut expiration, you are getting poorer every single year. You are running on a treadmill that is speeding up. Okay, enough of the doom and gloom. I paint this picture not to scare you, but to wake you up. If you know the rules of the game are changing in 2026, you can change your strategy now and actually come out ahead. Here is the Capital Sense playbook for the 2026 budget trap. We focus on 3 pillars: tax defense, hard assets, and pricing power. Pillar 1 is tax defense. If taxes are going up in 2026, you want to pay taxes now, not later. This is the year of the Roth conversion. If you have money sitting in a traditional IRA or 401k, that money is a ticking tax time bomb. The government owns a percentage of it, and that percentage is about to go up. By converting that money to a Roth IRA before December 31st, 2025, you voluntarily pay the tax now at today's historically low rates. Once it is in the Roth, it grows tax-free forever. The government can raise taxes to 90% in the future, and they can't touch your Roth. Consult your CPA, but for many people, locking in current rates today is a steal compared to what's coming. Pillar 2 is hard assets. We need to hedge against that financial repression and currency devaluation. Look at what central banks are doing. China, Poland, Singapore, they are buying gold at record rates. Why? Because gold is the only asset that is not someone else's liability. It cannot be printed. I'm not saying put 100% of your money in gold, but having a 5 to 10% allocation acts as insurance. When the dollar loses purchasing power, gold historically reprices higher to account for that inflation. Also, look at broad commodities. If the US is reindustrializing, we need copper, steel, and energy. ETFs that track these commodities are a great way to bet on the physical economy rather than just the digital one. Pillar 3 is equities with pricing power. Finally, the stock market. You don't want to leave the market, but you need to be selective. In an inflationary environment, you want companies with pricing power. Pricing power means a company can raise its prices, and you have to pay it. Think about it. If the price of your streaming subscription goes up, you might cancel. But if the price of your waste management service or your healthcare or your essential software goes up, you pay it. Look for companies with wide moats, monopolies or near monopolies. Avoid companies that are drowning in debt, because refinancing that debt in 2026 will crush their earnings. Focus on quality and cash flow. Dividends also become crucial here. If a stock pays you a growing dividend, that income stream helps offset the inflation you feel at the grocery store. The year 2026 is going to be a wake-up call for millions of Americans who are asleep at the wheel. The combination of high debt, expiring tax cuts, and sticky inflation is a difficult storm to navigate. But remember, wealth is rarely destroyed, it is merely transferred. It is transferred from the unprepared to the prepared, from the passive savers to the active investors. By watching this video, you've already taken the first step. You know what's coming. Now take the second step. Look at your tax strategy. Review your portfolio. Make sure you aren't holding too much cash. I've linked the official CBO reports and the tax tables in the description below so you can verify the numbers for yourself. Don't take my word for it. Do your own research. If you want to stay ahead of the economy, make sure you are subscribed to The Capital Sense. We don't just follow the news, we follow the value. Thanks for watching, and I'll see you in the next video.